there are three friends, and each one of them invest exactly 1 lakh every year. So this data is from January 1, 2008 to December 31, 2024. So during this period, there were multiple crises like global financial crisis, COVID, and Ukraine war. And along with that, there were many reforms in India as well. So you have everything like 52 week lows, highs, and good amount of volatility is also there. Now let's look at each investor's persona. Investor one, she invests only during 52-week low. So this she does it very counterintuitively. When everyone is excited, she's calm and doesn't invest. But when everyone tries to caution her, she invests. Luckily for her, every year from 2008, whenever she has invested, she could get a 52-week low. So investor two, this investor gets easily excited and invests money whenever there is too much optimism and frenzy in the market. Luck was never on his side, and whenever he invested, the market was at 52-week high. Then we have investor three. She doesn't believe in timing the market, and all she did was invest on 1st January of every year. So on January 1, 2025, all these three friends decided to compare how their portfolios were. So what they have done is they have looked at the units they have accumulated on each year and what would their present value is something which they have calculated, right, for all the both three investors. Now they looked at their absolute values and calculated the rate at which they have got the returns. Say the best investor that happens to be the investor one. So her return was at 13.6%. That's the highest. And the worst one, investor two, he could generate only 10%. Then the investor three, she could generate 11.2%. So the key takeaways here are the worst investor still made a return of 10%, and the best with all the luck on her side could make a return of only 13.6%. That means over long horizons of time, loss of average will definitely be in play, and the delta between the best and the worst return will shrink. See, if this guy stayed invested for another 10-15 years without any contribution, and even with contribution, most likely the delta will be probably less than 1%. So this is an example where one investor was extremely lucky and the other was extremely unlucky. But the third investor was someone who invested consistently without trying to time. In the 17 instances for the past 17 years, uh, she could capture two instances of 52-week low, that is in year 2018, 2017 and 2012, and one instance of 52-week high. So in real life, these are the odds at which an investor can really get a high or a low. So they are very low, provided you are a consistent investor. If you are somebody who is timing the market, your chances are even low. The final lesson is that asset allocation and financial goals are what matters the most. So with a lesser horizon, equity investment can be very dangerous. If you have right asset allocation and are a consistent investor, and you are having some surpluses during a market drawdown, probably you got a bonus or else maybe some arrears if you are a government employee. And if you can invest whenever there are certain market drawdowns, probably your return will be higher than this 11.2%. And if you do this process consistently, maybe you will move in the direction of this investor. Obviously, you will not be getting that highest return. So, but somewhere between 11.2 and 13.6 is where you can easily end up. Finally, when you do such an analysis, you have to look at the constituents of the Sensex as well. So, of the 30 companies in 2008, right now only 15 are part of the Sensex. So, if someone really wants to generate stellar returns, the person should focus on valuations, companies of the future, right? Maybe you want to buy the companies which will be moving into Sensex in the next few years, and maybe you want to avoid the companies which will fall out from the Sensex, right? And not on timing the market, especially. And then other two important aspects are time in the market and the asset allocation. Even though the investor too, he has got the least number of units in the 2008 year, right? But this investment, he stayed put for over 17 years now. So in the 17 years, his 1 lakh has become 3.56 lakhs, right? So approximately, he has doubled his investment around 8.5 years. So that is again, he has generated return. Maybe it will be around 8.5 to 9%. So even in the worst cases, it is better than the fixed deposit, right? And for see, and in order to get all this stuff, right, where you have to identify the companies and get the right valuations, and maybe you want a re-rating on the companies, you have to go to an active fund manager whose strategies are in line with your thinking and that works really well with your asset allocation. So an average investor who is having a day job will not be having a time to perform all this analysis. Maybe you'll do once or twice, but on a consistent basis, you will not be doing it. So the best way is just to, invest consistently through a SIP. So if you are somebody who doesn't even have time to look at the active fund managers, probably the index funds will work for you, right? And finally, this video is for educational purpose only. Again, it is neither a recommendation to buy or sell the asset class in the discussion. Thank you.